Hello, everyone. This is Gary Luna with Dynamic Wealth Management. We are at the end of June, in fact, June 30th. And so we're starting a new month. That means a new market update video. It's my turn to do it, so let's go ahead and jump into the charts. Hope everybody's doing well out there and staying cool as we are now in the thick of summer. Let's see here, make sure everything is working. All right, let me move me out of the way. We're going to start off with looking at some asset classes year to date. So we're looking at the S&P 500, the Dow, NASDAQ, small caps. Those are all domestic indexes. Then we're going to look at international developed countries, international emerging markets, the US dollar, commodities, real estate in the form of REITs, and 10-year treasuries to represent bonds. So as you can see, where is money going? Wow, not hard to see, but technology has really taken off, right? You got some big companies out there that are really driving that index and really pushing up overall the S&P as well. Notice that the Dow is lagging, and overall we would have to say that generally the U.S. market is outpacing relatively strong. Compared to most international countries, especially the overall emerging markets index. We see that pretty much everything is up except for commodities, right? We see that that is lagging for the year, but even real estate and even treasuries are up a bit, which is nice to see because obviously treasuries and the market did not have a good year last year. Let's keep going. Now we're going to look at, let's get me out of the way again. Now we're going to look at sectors for the S&P 500 again year to date. So the S&P 500 here, which is the last one, up about 15 or 16% for the year. That's pretty darn good. So where is that coming from? Where's that performance coming from? Again, notice the best sector then is, like we talked about with NASDAQ, technology, followed by communication services, and discretionary stocks. So definitely that is the lion's share of performance for the S&P 500. Sectors that are not doing well, energy, and we just talked about commodities being down, so that makes sense that energy is one of the drivers overall of commodities. Utilities is down, healthcare down a little bit, financials and staples, real estate up a little bit as well. So definitely the major performance coming out of these three sectors. Let's keep going. All right, let's answer the question year to date. What is the best performer as far as market cap, right? Market cap means large companies, mid-sized companies, and small companies basically. So as we're looking year to date, right, so you're seeing the different charts there. Large companies has been the place to be so far in this year. Relatively stronger, and the one that's lagging is small companies in the form of small caps, right? Mid caps at about 7 and small caps at about 5 year to date. So definitely larger companies are doing much better so far year to date. All right, this is an interesting chart that I thought I would add to give you an update. So about a week and a half ago now, the Federal Reserve met and they decided to hold off raising short-term rates. Now, they had been raising rates pretty consistently for about a year, and you can see here the direct effect of that. So the blue line represents the federal funds rate, right, over the last, and now we're looking at a 30-year history in the market. And then the green line represents the S&P 500. So you can see here that beginning at the beginning of 2022, the Fed, to fight inflation, raised short-term rates, and they did it in an unprecedented fashion, all the way up to about 5.5. Here you can see what the S&P 500 did at the same period of time. Of course, last year was not a good market year, and now the market is trying to repair itself which year to date, it's doing a pretty good job of doing that, right? But this paints a good picture for where we've been and potentially where we can go. Because one of the things the market knows is that when the Fed holds off, like it did here and like it did here, that that rates will stop, will plateau, and then the next step somewhere down the road is back down again. And really that's kind of what the market is starting to price in. They know that we are at the probably the tail end of short-term rates raising. And so it's widely expected, and I think we're starting to see it priced in the S&P 500 that the market believes that the Fed will probably hold off for a period of time, but they do know that somewhere down the road, rates will then go back down again, and that's overall good for the market. So higher interest rates in the form and higher inflation has been the number one thing weighing on this market. So that's important to continue to watch that and see what happens as we go forward. Here's a chart of the S&P 500, and again, I'll move me around so we can see that. So if we go back to the beginning of 2022, we can definitely see lower lows, right? Lower lows here, which is basically the definition of a downtrend, which is marked by that red trend line. Well, we have to say that we are seeing higher lows and higher highs to form an uptrend beginning about October, mid-October. Looks to be the low point over the last about year and a half. And so notice of late, the S&P 500 has gone ballistic, really has picked up to the point where we are hitting new highs for the year, which is great to see. But as always, we believe that the stock market is getting a little bit ahead of itself. On the downturn, it overdoes things, and on the upswing, it tends to overdo things. So we're thinking that this thing is due for a bit of a pullback, which will give us opportunity somewhere in this area, hopefully, to add more money longer term, as we think that things are definitely improving as shown by market price action. Here we're looking at the volatility index, so that is the top line here that we're seeing as compared to the S&P 500, which is down here below, that we could see price action. So as the market has improved for the year, notice that the volatility index has gone down. That denotes complacency, and on a contrarian basis, that might mean that we're also due for some pullback, again, to give us an opportunity to maybe put some more money at this thing. One more indicator, this is an oscillator. It's called the McClellan oscillator up here. Again, as compared to one of the key indexes, which is the New York Stock Exchange. And notice that as the New York Stock Exchange has gone up, that we are at a point, nearing a point where we're probably more overbought than oversold. And again, every time we've been overbought, if we look back, that has been opportunities where the market has turned and gone the other way, here, and here, for example. And so, again, the plan would be as we near more overbought territory, that potentially could give us some room to potentially add more positions into some of our models that are more on the aggressive side and the growth side. One more indicator to kind of paint the picture of things. Again, I'll move myself around. What we're looking at here is, again, the New York Stock Exchange here above, and we're looking at the new 52-week or yearly highs and the yearly lows. So are we having more yearly highs or more yearly lows recently? Obviously, on the spike here, we can see that we have 327 brand new yearly highs in the New York Stock Exchange every time that has spiked up. Like here, for example, that has been a time when the market has finally pulled back, or coming back here like this, that has been a time when the market does pull back. So again, we're hoping that these things collectively paint a picture that we're due for a bit of a pullback, and that might make some sense to put some extra money at this thing for a longer term uptrend. Let's give you an update of what's going on with our model allocations here. So overall, in the main ETF trend following model, we are at the point where we are getting into our green zone. We'd like to be in the green zone, but again, we're looking for opportunities for pullbacks to get into that green zone. So right now we are at the top of the yellow zone, still in more of a neutral stance, but definitely leaning over to the green. So again, the plan would be, as the market comes back to us a little bit in the next month or so, we want to add more positions to fully get into that green zone. So if you are in that particular model in one of your accounts, this gives you a reminder if you are a growth, moderate, or conservative client. Again, within that yellow zone, it gives you an idea of allocations. A growth client would be a 60-40, moderate client would be a 50-50, conservative client would be a 30-70. As we move into the green zone, expect to see then allocations go from more defensive to more risky assets. And let's give you an update on our sector model. Let's see, let me move me around again, get out of the way. So in our sector rotation model, right, we're looking at, this is the actual allocation that potentially we will take on the first day of July. I put probable because basically I'm recording this video near the end of the market day on June 30th, Friday. And so remains to be seen if this will hold true, but it should be pretty close to what the allocation will look like. So basically, to give you a reminder of how our sector rotation model works, we have 17 sectors and/or industries, and we have a proprietary ranking system whereby we rank by performance and volatility each of those pieces of the puzzle. And notice the higher ranking ones on top, the first 8 represent the allocations we actually take. So we have a lot of greens in our top 8, which is great. The only one we have grayed out is gold, which is number 2. And that means that gold recently, or as of the recording of this video, dipped below its own 6-month moving average. So we will replace gold with a short-term bond treasury position. So pretty much we're going to be all in on the sector rotation model. I think percentage-wise, only about 12.5% represents the short-term bond position, which is an improvement. And to give you an idea of kind of how that works, just to paint a visual for you, I'm going to walk you through the different rankings we've had. This is the current ranking. That's the ranking I just showed you. And again, these are the 17 sectors and industries. And notice a lot of improvement from where we have been or where we were last month, right? We had about a 30% improvement because you had a lot of grays in there. And so we like to see a lot of color, right, in the form of, the colored sectors, meaning that those are sectors that potentially we will take as allocations. So if we're painting the picture, I thought this would be instructive for you to compare 2023 to 2022 to 2021. So let's start with 2021. So a couple years ago was a pretty strong market, pretty good market. So as you can see in our rankings across the different months, wow, you had a lot of colored in sectors and industries, meaning especially right here in the middle. All of sectors and all of the industries except for 2 are grayed out. That means that all of them are above their own 6-month moving average. And now when we're ranking them, we're basically ranking a lot of growth sectors, no bond sectors at all, right? So very strong market throughout 2021. At the end of the year, we start seeing some grays, right? Especially in September, meaning weakness. Some selling off is going on in September, right? So let's keep going, and we're going to compare this picture to 2022 when the market started to really get weak. Into the brand new year, into January, right at the beginning. you got a lot of the sectors that are going gray, meaning that there's a lot of selling going on across the board in all the major sectors, right? And then as we go forward here, notice a lot of weakness. In fact, again, I'm going to move myself out of the way. Notice June, everything is below its 6-month moving average. And that represented a bottom in the market. The other time was in October or right in September. Wow, everything was selling off into September. But as we get to the latter part of the year, right, we just saw it in the big chart on the S&P 500. We started to see some improvement. Now we're going to go to 2023 and give you an idea of kind of where we stand now. So again, I'll move myself out of the way. And basically now we're starting to see the market continuing to improve. We did see a sell-off period last month and we did get a little conservative, but this month has improved somewhat by about 25% or so, almost 30%. So we'll take that. So basically we hope that we are entering a period here for the next few months where we have more things that are showing strength, right? More sectors that are above their own 6-month moving average and are ranked high so that we could make more money for clients, basically is what it translates to be. So hopefully that makes sense. So I'm at the end of my video here. Hopefully that was instructive for you. If you have any questions on your particular portfolio or anything that you'd like to talk about, don't hesitate to give us a call. We'd love to talk to you about your particular situation. And as always, these videos are just informative in nature and educational, not an exact recommendation for buying and selling of any investment or sector. But anyway, hope you're having a great summer and we look forward to seeing you soon. Take care.